Uber Technologies reported EPS up 85% year over year, but almost half of that came from a $1.6 billion equity investment gain that has nothing to do with the actual business. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Uber Technologies gets graded and traded. So on the headline, revenue came in basically in line, down about 0.3% versus estimates at $14.2 billion, up 12% year over year, which is solid, but not the blowout you might have expected given the strength underneath. And on EPS, they missed by about 2.5%. But here's the thing. The reported GAAP EPS was $1.17, up 85% year over year. That number is heavily inflated by a $1.6 billion gain on their equity investments. Strip that out and clean operational EPS was 81 cents, up about 35%. Still strong, just nowhere near what the headline suggested. So on the beat itself, this earns a C. A small miss on both lines against estimates is what it is. But I want to be clear, the underlying business is running way hotter than that C suggests. We're just grading the surprise versus expectations here. And on consistency, this also earns a C. Uber Technologies has been beating pretty reliably, and coming in slightly light on both lines this quarter breaks that streak a little. Let's talk about the positives from the report. The headline story here is cash generation. Trailing 12-month free cash flow crossed $10 billion for the first time in company history. That's a huge milestone. It converts Uber Technologies from a growth story into a cash return story, and that changes how the whole market thinks about the name. And the margins are the impressive part. Adjusted EBITDA margin as a percent of bookings expanded to 4.9% from 4.5% a year ago. That's operating leverage showing up cleanly across the whole business. Gross bookings grew 22% on a constant currency basis to $58 billion. That's the top of the funnel, and it's still compounding at a really healthy clip even at this scale. They repurchased $3.5 billion of stock year to date. Diluted share count is down about 75 million shares year over year. That's meaningful enough to actually move the per share math. And user growth is still strong. Monthly active platform consumers grew 16% year over year to 208 million. Management called out more first-time users added over the last 12 months than in any period over the past 5 years. So, on profitability, this earns an A-. Margin expansion across the board, 40% non-GAAP operating income growth, and the $10 billion free cash flow milestone. This is about as clean a profitability picture as you get at this scale. Now let's talk about the negatives from the report. The biggest thing here is the GAAP EPS number is misleading. That 85% growth was juiced by a $1.6 billion gain on their equity investments. The clean operational figure is closer to 35% growth. Anyone who anchors on the headline 85 is going to materially overstate what this business actually earned. The mobility segment is where things get weird. Bookings grew 22%, but revenue only grew 1%. Management flagged a business model change that created an 8-point drag on reported revenue, but they didn't really unpack it. That optical divergence is going to be a talking point every quarter until the comps normalize. Unrestricted cash dropped from $7.6 billion at year end to $5.4 billion at the end of Q2. The combination of $3.5 billion in buybacks, total return swaps, and acquisitions is meaningfully drawing down liquid resources. The Q3 guidance points to a deceleration. Bookings growth is guided to 18 to 22%, down from Q2's 22. EPS growth is guided to 28 to 35%, off the peak. The growth curve is bending, even if it's from a very high base. and freight is still bleeding. $24 million operating loss this quarter, essentially flat with last year. The third leg of the platform is still burning cash, and there's no visible path to profitability laid out here. So on guidance, this lands at a C+. They gave real numbers, and the numbers imply deceleration, but from a very high base with margin expansion still intact. Not a raise, not a cut, more of a steady as she goes. And on red flags, I'm at a B-. The mobility revenue versus bookings gap is the one thing I can't fully dismiss until they explain it better, and the cash drawdown is meaningful. Nothing critical, but real concerns worth watching. Putting it all together, the underlying business is firing on almost every cylinder. Cash generation, margin expansion, and buybacks are all working simultaneously. The optical stuff around the inflated gap EPS and the mobility revenue gap creates some noise, and the guide implies deceleration, but strip out the noise and this is a genuinely strong quarter. I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The operational print here is clean, with non-GAAP EPS up 35% year over year and trailing free cash flow over $10 billion. So I'm comfortable starting a position instead of waiting for some huge pullback. My move is to sell cash-secured puts moderately out of the money while any leftover implied volatility from the report is still sitting in the options chain. I use the third quarter guidance floor of 18% constant currency bookings growth as my mental anchor for how much downside cushion I want in my strike. So I'm starting small with cash-secured puts. The strike floor I trust has to survive a third quarter guidance miss, meaning it sits below where the stock would trade if bookings came in at the low end of the 18 to 22% range with no margin expansion. Anywhere close to the money is only justified for me if I would genuinely be happy taking assignment, because deceleration from 22% down to that 18 to 22 range is a real thing. The mobility revenue optics could also pressure the tape on any given day, so I'm not selling puts I'm not ready to own. So I'm striking below that guidance miss floor. I'm holding and looking to add on weakness because the $10 billion trailing free cash flow milestone genuinely strengthens the ownership case compared to 3 months ago. Adjusted EBITDA margin expanded from 4.5% up to 4.9%, and that kind of margin trajectory is exactly what I want to see. The buyback of $3.5 billion year to date is another reason I'd only trim if I were overweight, because there's nothing in this release arguing for less exposure. So I'm holding and adding on weakness. My bias is to roll my covered calls up and out rather than letting the shares get called away, because this release supports a higher medium-term price than most existing strikes were written against. The free cash flow milestone and the margin expansion tell me the stock deserves more room to run, so I don't want my old strike capping the upside. If my current strike is close to the money going into the print, I think about closing early or rolling before implied volatility fully collapses, so I can capture that premium while it's still elevated. So I'm rolling up and out, not letting them go. I'm holding my leaps because the release meaningfully strengthens the 12 to 24 month thesis through the free cash flow milestone and margin expansion across both mobility and delivery. Management framed the company as the world's largest autonomous vehicle platform, And that's the kind of long-term optionality my leaps are designed to capture. There's no reason to roll defensively on the third quarter guidance deceleration, because that softness is coming off a very high base and the margin trajectory is intact. So I only take profits if the position has grown too big for my portfolio. So I'm holding, the thesis is stronger. The release validates the original thesis for me, with adjusted EBITDA margin expanding from 4.5% to 4.9% of bookings. So averaging down is defensible logic here. Non-GAAP operating income grew 40% and trailing free cash flow hit a record, and those are bull case confirmations, not warning signs. The one thing that would invalidate the case is if the mobility revenue to bookings divergence widens materially in the third quarter, so I size my ads in measured pieces with that specific risk in mind. So I'm averaging down in measured pieces. Bottom line, this print earns a B- from me. The $10 billion free cash flow milestone plus margin expansion plus an active buyback is a real inflection for the story. The mobility revenue divergence and the guidance deceleration are the things I'll be watching next quarter. Thanks for watching, and I'll see you on the next one.